Hello and welcome to BQ Prime. I'm Hira Zadia. Overall, a lot of movers and shakers in trade today markets are trading under pressure as well. Joining us on the show is Pankaj Pandey, Head of Research at ICICI Direct, joining in. Welcome to the show, Pankaj, and a very good morning.
Hi, good morning.
Pankaj, let's start with the IT pack as a whole. The pressure continues in today's day of trade with regards to IT stocks, but the kind of performance that we've seen since the first week of January to now has been pretty encouraging. It's not only the large cap IT counters, but the mid cap IT stocks as well, which are doing pretty well. What's your view in terms of IT stocks as a whole, taking third quarter commentary into consideration and what lies ahead?
So IT as a sector has sort of outperformed in 2023 so far up till now. Overall commentary from most of the companies has been pretty good. And so this sector from a 3-year perspective looks quite good from the perspective that you will have cloud transformation opportunity which will come, which is a multi-year opportunity. Then near term, you are getting cost optimization deals, and then you have new areas like AI or low code market or blockchain. So all of them are going to sort of help IT in terms of overall sustaining the growth. Since this sector has sort of rallied, our sense is that probably some bit of a profit taking can happen, given the fact that most of your Qs, especially in the US, are still sort of bearish, given the fact that the US economy is still sort of holding up pretty strong. But having said that, our sense is that any kind of a major weakness will be a sort of a buying opportunity in most of the companies because margin profile of IT companies is likely to see an improvement largely because of supply side challenges sort of easing up, then lowering of the subcontracting cost, pyramid optimization, and number of other things. Then there is an opportunity also in terms of vendor consolidation sort of playing out. So we like a couple of names besides the tier one. So for example, Sonata is looking good to us. Here our target price revival is about 835. We're looking at 23% CAGR kind of a growth. IT services should do very well, which is what the management has guided to closer to about $500 million kind of a revenue by 526-27. Coforge is another company which is looking good to us. I think they are one of the few companies who are sort of sounding very confident of delivering 22% kind of a constant currency revenue growth. Even after that, you'll see mid-teen kind of a revenue growth panning out in FY24. They've got the lowest attrition levels. Some of their verticals like travel is already sort of doing well. So that is another company what we like. Persistence is another company where we've seen good growth last quarter, and our overall sense is that their TCV1 was one of the highest ever they have seen. Attrition, yes, is sort of coming down. This is one company which is quite confident also in terms of looking at inorganic growth also, and they're getting pricing hike also in certain cases. And then the tier one, I think Wipro looks interesting to us because overall revenue guidance of 11.5 to 12% is quite attractive. It's trading at about 16 times FI 25. And overall, when we sort of look at, while the numbers were softer, but the TCVs were up 26%. So one of the highest what we have seen. So whenever that gets converted into revenues, our sense is that it will deliver high single digit kind of a top line and bottom line growth. And Cyient is another which is also sort of done phenomenally well in terms of quarterly numbers. I mean, 12% kind of a constant currency revenue growth. Obviously, some bit of a good part of it was driven by inorganic, but organic growth also was closer to 4%. So that sort of quite looked attractive to us. So in general, overall IT as a pack is looking attractive to us. But since they have rallied in the near term, our sense is that probably yes, some kind of a profit taking can happen because US economy is still sort of holding up quite strong. So I think Fed is going to remain hawkish, and that might have a sentimental negative impact on the overall IT as a pack.
Right, so that's with overall IT as a pack. Moving on from the auto space, you have a Bajaj Auto, which is trading under pressure in today's session because there are a lot of reports which are suggesting right now that overall production is expected to go down. In fact, last when we spoke to the management as well, they clearly indicated that it will take a couple of months for Nigeria to be up and running. But it seems so that, export-oriented factories are going to take a production cut. because Nigeria has not been up and running as much. What's your view with regards to a Bajaj Auto?
So in general, two-wheeler as a space, we don't really like so much within the entire auto pack. One, because the domestic recovery is not great. Volumes are expected to grow in single digits. Coming specific to Bajaj, export is a sort of a big contributor for them. I think in FY22, they exports contributed 58% of their volumes. So while fundamentals good, I mean, this company is sitting on good amount of cash. Return ratios are one of the best. Has got good dividend yield. But like you said, what we are facing is that export monthly volumes, which were about 2 lakh, probably it could drop to 1 lakh. And we don't really see things getting revived, say, not before May or June. And which is why things are really not looking so great, despite having one of the best sort of balance sheets in the auto as a pack. So we have been sort of maintaining hold rating on the stock till the time both domestic and export as a segment does not get revived. I think even though the stock might look attractive at 15 times earnings, but I think nothing much we would expect in terms of price performance.
Right. Moving on, Indigo, another counter. If you see in terms of the stock price performance of Indigo, the stock is down almost around 12 to 13% in the last 1 month. There is a lot brewing in this space as well in terms of what's happening with crude prices. Air India coming in a big way in terms of competition. And now you also have, more than 50 of the planes which are grounded over the engine snag in terms of P&W engines. What do you make of an Indigo, and what would you advise an investor to do?
So in general, aviation has one space which we have not sort of covered because of number of reasons. Now, one is when you sort of look at slots, so these are sort of made available on a first come first basis. Typically, globally, the practice is to sort of auction these slots, and slots obviously have a big impact in terms of what timings you carry for flights to especially major destinations. And when you sort of look at now in this sector, you have a big company sort of coming in a big way. So obviously things are very challenging. We don't know whether you'll see I mean, industry competing on prices, or would there be any other sort of a layer. So till that time, things would remain challenging. While the domestic flyers have been inching up, so I mean, we have already crossing 4 lakh flyers on a daily basis. Outlook looks attractive, but I think the industry dynamics are still sort of changing. So, which is why we have not been sort of tracking or recommending companies in this space as of now, including Indigo.
Right. Moving on, from the telecom space, you have a Bharti Airtel also, which is in focus right now. We've been hearing of talks in terms of, what's happening between Bharti Airtel and Paytm. No confirmations yet on that front. But apart from that, in terms of the tariff hikes that Bharti has taken as well, and if you see in terms of 5G rollout, the kind of capex that both the companies are investing in, what's the sense that you pick up for the telecom space and specifically for a Bharti Airtel?
So I think telecom, the key variable to sort of watch out for is price hike. So that is still not sort of happening, contrary to what one would have anticipated, or even what the companies has been sort of guiding for quite some time. So from that perspective, near-term price performance has been a miss, especially in Bharti Airtel. So while African business is still sort of doing good, company clocked one of the best margins last quarter. But the challenge always is that we may not really see much of a growth, except for the fact that some subscriber growth is happening for both Jio as well as Bharti Airtel, because Voda continues to sort of lose market share. But I think data is something which is an important lever to sort of watch out for. So data consumption, our sense is that probably with IPL coming in, one needs to see what kind of data growth do we see. So that is the only volume lever which can sort of pan out. Otherwise, pricing as a growth is still sort of absent. So I think you still don't have near-term good triggers for this stock to sort of do well. Structurally, we like this company largely because the price hikes will happen, given the fact that both these biggies are sort of spending a lot of amount on 5G rollout. But near term, it's more of a wait and watch. But from a 3 year perspective, our sense is that this is one space where the two players or duopoly can sort of can command pricing power and can deliver a good set of numbers. But near term, it's more of a wait and watch.
Right, so that's a wait and watch coming in there from an Airtel. Moving on, Adani Ports, as we know, there has been a lot of pressure in terms of the counter. However, it's the third consecutive session where we are seeing an up move coming in there, and they have crossed 300 million metric tons of cargo handling as on the 23rd of February in just 329 days, which is beating its old milestone from last year's 354 days. Taking business prospects into consideration, Pankaj, what's your view on Adani Ports from a valuation perspective as well? Because the stock has corrected so much, do you think these could be good entry levels as well?
Absolutely. So Adani Port has largely remained range bound, say in the say 550 to 600 kind of a levels, and largely because the kind of pressure what you see on most of the Adani group set of companies. But we like this company. Here our target price is about 800. Why we like is that it has got a strong free cash flow of FCF yield of nearly 5% in FY24, and they've got 14 ports, a good number of trains, and 15% ROS. Debt equity levels are also comfortable, and I think they command about 25% of the EXIM cargo. Now, EXIM is a bit soft, but our sense is that things will improve from here on also. And overall, their stated intent is to have 40% of the EXIM market share. Now, when we sort of look at overall EBITDA, our sense is that they can easily sort of deliver EBITDA of nearly 14,000 to 15,000 odd crores, and that places them comfortably on the debt equity side. Majority of the capex is done, so at best you will have 4 to 5,000 or odd crore kind of a capex. And volume guidance is still sort of intact of 500 million tons. Like you said, the 300 million tons is already sort of achieved. So fundamentally, we don't see much of a challenge for this company. Which is why we feel that despite the near-term weakness, from a 2 3 year perspective, it looks good to us with a target price of 800.
Right. Moving on, Sanofi India as well. That stock is, if you see in terms of today's session, is up almost a little over 5%. And in the last 1 year as well, it's actually underperformed. But now you're seeing that uptick that has started to come in on this counter. If you see in terms of the earnings as well, the margins have been strong. And clearly the indication is they will improve further with the mix and productivity changing. What's your view on a Sanofi India? Do you think good time to enter?
So we are maintaining a sort of a hold rating on this stock. Like you said, it has sort of underperformed, and the reason is that when you sort of look at last 5 years, the domestic CAGR is 7%, which is quite lower than the overall Indian pharmaceutical growth rate of low double digits what we have seen. So challenges are still there. We really do not see this company sort of outperforming. While when you sort of look at Q4 numbers, the numbers declined 3%. But I think if you sort of look at the domestic business that grew about 4%, the business which is what they are continuing, and then export growth was good. I think good part for this company is that it's a sort of a dividend paying company with a dividend payout ratios of 50 to about 100 times. 100 happens in special circumstances. And then now the company is looking to sort of focus on higher margin accretive business, and probably would plan to increase the CDMO sourcing from India. So that's a sort of on a positive side. But I think overall setup is still not very good enough because when you sort of look at one of their key products, which is Lantus, which used to contribute about 20% of their, so there the growth is still sort of sort of a challenge. So I think till the time they don't really outperform the domestic market, pharmaceutical market, I don't think we'll turn bullish on the counter while fundamentals are good, and which is why we are sort of maintaining a hold.
So that's a hold coming in terms of Sanofi. And the last stock, Pankaj, I want to talk to you about is a Mahindra CIA, an interesting play as well, because if you see the kind of performance in terms of the stock, it's already hit a 52-week high recently. The stock was up almost 125%. Now, overall, do you think now is the time when we will start seeing a lot of profit booking happening on the counter and the valuations are turning out to be expensive? Or do you think the business actually demands the valuations it warrants the valuations it is demanding right now?
So, like you said, given the sharp run of what we have seen, some kind of a profit taking cannot be ruled out. But I think once that happens, that will be a good entry point for any new investor. Here in this company, we are maintaining our target price of 500. Now, why we like this company is that when you sort of look at, they have recently sort of divested or put German business set for sale, and post that, 65% of the business will come from India and 35% from Europe. Now, India is typically a business where the EBITDA margin profile is 15% plus. And that is one segment where the company is doing capex also. Europe is obviously a low margin business. So as and when the domestic operations keep contributing more, you'll see the blended margin profile sort of getting better. And in fact, the parent is looking to sort of guide for an average what you call margin profile of 17 to 19%. So there is still a good amount of legroom for margins to sort of inch up. And which is why we are sort of penciling in low double digit kind of a growth with better margins. And I think this company has got strong free cash flow yields of 5%. So from that perspective, look good to us. We valued at about 20 times. So any kind of a profit taking in the near term, I think will be a sort of a good buying opportunity in the stock. We like the stock from a portfolio perspective.
Right. So that's a good buy coming in with regards to Mahindra CIE as well. Thank you, Pankaj, so much for joining us on the show and giving us direction in terms of what should be done with few of the stocks which are moving in trade today. Thank you. Stay safe and speak to you soon again.
Thank you so much. Pleasure interacting.